basically mainly the questions will be ranging from banking, the chapter of banking and the digital currency. These topics will be there, and we will be discussing the topics both objectively as well as in detail, as and when, as per the requirement of the question, right? So let's see the first question. Consider the statements with reference to priority sector lending. Priority sector lending. So this was introduced in 1972. It was introduced in 1972. What is priority sector lending? Basically, it is credit rationing. It is a part of credit rationing. What does it mean exactly? Is, see, banks want to lend to the people who can return the loan back. So bank don't want their loan to be non-performing asset. Means they want their loan returned back, right? So what happens is banks lend to only those sectors which are profitable. Then who will lend to agriculture, which is risky business, right? Who will lend to loan for housing? Who will lend loan for education, right? So what government did? Government brought a policy that these are the priority sectors. Your 40% of your total credit shall be directed to these particular sectors. They mentioned 8 sectors, including MSMEs, including renewable energy, education, housing, right? Agriculture. So in agriculture, they said the 18% of the entire priority sector lending. The target is 40% in priority sector lending. The target is 40%, right? 40% of total credit shall be given to this particular sector. So there are 8 sectors mentioned. The Reserve Bank of India brought in priority sector lending PSL norms for banking in 1991. No, it is not a part of liberalization, privatization, and globalization. So priority sector lending was brought way back in 1972. In 1972. So this question basically is confusing you with LPG reforms also. So it is way before LPG reforms, that is in 1972. Under the rules, a banking entity needs to lend 40%, of the adjusted net bank credit to the priority sector. It is correct. If a bank fails to, if a bank fails to meet the target prescribed under the PSL norm, it has to deposit the allocated amount for contribution to the Rural Infrastructure Development Fund, because mainly it is targeting rural development. So if bank fails to meet the target of PSL norms, they deposit the allocated amount for contribution to the Rural Infrastructure Development Fund, right? So this is also correct. The PSL norms are applicable to all commercial banks, small finance banks, cooperative banks, and foreign banks. These are correct. It is to small finance bank, cooperative banks, foreign banks, but it is not applicable to regional rural banks, not to RRBs, right? It is not applicable to regional rural bank. Since regional rural bank is not given in the option, the statement is correct, but you have to remember that PSL norms are not applicable, priority sector lending norms are not applicable to regional rural banks, right? So this statement is correct. Option is 1 is not correct. So 2, 3, and 4. Option B, right? Let's move to next question. Okay. There are 4 phases of business cycle. Identify the correct sequence of occurrence of these phases. So business cycle, basically we learn about it in GDP growth. We learn about it in the chapter of inflation also, how we target inflation, when to target inflation, right? So you can take a help of a graph like this. If I can draw, this is GDP, this is time. So it is like this. See, this is boom period, right? See, if I can distinguish it with different colors, this is boom period. This part is boom period. in boom period, what is happening? GDP is also increasing, inflation is also increasing, right? In boom period, what happens is inflation, GDP increases, GDP growth increases, growth rate increases, as well as inflation increases. So in boom period, RBI targets, RBI chooses contractionary monetary policy, right? Contractionary monetary policy means you have to control. So you will be putting cap on the interest rates. Interest rates will be higher, right? So liquidity will decrease from the economy. So what will happen? See, this is boom period. Now, when contractionary monetary and fiscal policy will be implemented, now it will be a slowdown. So in slowdown, as you can see, GDP growth is declining. Growth rate is declining. GDP growth rate is declining, but it is positive. GDP growth rate is declining, but it is positive. For example, if GDP growth here was 10%, now it is 7%, 6%, 5%, but it is positive. Slowdown means GDP growth is declining, but growth rate is positive. For example, from 10% to 5%, 10% to 4%. Still, growth is there, but growth rate has declined. Now, when it becomes negative, when the GDP growth rate becomes negative, means actual fall in GDP. Actual fall in GDP, it is known as recession. It is known as recession. Right? See, boom is happening, GDP growth is increasing, GDP growth rate is also increasing, right? Now, what happens in slowdown? In slowdown, GDP growth rate declines but remains positive. What happens in recession? GDP growth rate has declined and becomes negative. And the technical definition of recession is GDP growth rate remains negative for 2 quarters. GDP growth rate remains negative for consecutive 2 quarters amounts to recession. It is a technical definition of recession. So this is recession, negative GDP growth. But if this recession persists for a longer time or longer period, it gives the situation of depression. It gives the situation of depression. For consecutive 2 quarters, GDP growth rate is negative, it is recession. If recession persists for a longer period of time, it is depression. Now, if expansionary policy is taken by the central government as well as by the RBI, RBI will take expansionary monetary policy and Government of India will take expansionary fiscal policy, then recovery begins. So this is a phase of recovery. This is a phase of recovery, right? Recovery. Fine. So this is a business cycle. What happens is when boom is there, when boom period is there, GDP growth rate will be higher. GDP will be increasing. GDP growth rate will be higher, as well as inflation will be at higher side. So to curb inflation, if contractionary monetary policy and contractionary fiscal policy is taken or implemented, then slowdown takes place. And what is slowdown? GDP growth rate is declining but remains positive. It is slowdown. And when GDP growth rate becomes negative, it amounts to recession. And what is the technical definition of recession? GDP growth rate remains negative for consecutive 2 quarters. For example, what we saw during COVID-19 pandemic. So India saw its first technical recession because quarterly data was not available earlier. So what we saw is earlier recession was on the basis of annual data, but the technical definition of recession is for 2 consecutive quarters. So in India, we saw first technical recession during COVID-19 pandemic. And if recession persists, it gives rise to depression. And after depression, if expansionary monetary policy is implemented, expansionary fiscal policy is implemented, recovery begins, and this is a part of recovery, right? then again the same thing will happen. After recovery, boom will come, then slow down, right? So it happens like this. So now they are asking you to identify the correct sequence. See, how do I identify the correct sequence? Recovery will not lead to recession. Recovery will not lead to recession, and recession will not lead to expansion. So this is not correct. Recovery, expansion, depression. No, expansion, depression is not correct. Rather, depression, after depression, recession will not come. So this is not correct. Depression, expansion, recession, recovery, not correct. Recession, depression, correct. Depression, recovery, correct. Recovery, expansion, correct. What is boom period? We understood. Here it is as expansion, right? So this is expansion. So correct option will be D. Answer D. Right? Let's move to the next question. The third one. Questions are visible, I guess, and you have question paper with you also. So, right? So we will see the third question. The elements given below are some of the parts of M4 money supply of Indian economy, broad money, all deposits. First, we will try to understand M0, M1, M2, and M3, right? So, what is M0? M0 is currency available with public. So, currency with public, it is M0. Currency with public plus deposits with RBI. The commercial banks, the cash reserve ratio that you have learned. So cash reserve ratio will be deposited to RBI by the commercial banks. So deposits with RBI plus other deposits of RBI. What do you mean by other deposits? So other deposits means, for example, international institutions like UNDP, United Nations Environment Program, like they are depositing their money to RBI. So this is M0. M0 is currency with the public plus deposits with RBI, that is mainly CRR, the amount of CRR by the commercial bank, and other deposits to RBI. So this is M0. What is M1? This is M0, currency with public and all. M1 is currency plus demand deposits. Now, what is demand deposit? Demand deposit is nothing but the deposit made into saving account or current account, both saving as well as current account. Demand, you demand money at any time you want, right? So at any time, that is demand deposit. At any time, if you are demanding, that is demand deposit. For example, you are using your ATM card. So you are going to an ATM machine and you are withdrawing some money, that is demand deposit. You are going to the bank and by filling the withdrawal slip, you are withdrawing some money from your saving account or current account. That is demand deposit. So this is M1. In M2, what we do basically, in M2, M1 is there, means everything, currency plus demand deposit will be there. You will include in M1 post office saving deposit. Post office saving deposit. Post office saving deposit, but not including the national saving certificate, because national saving certificate, the scheme was given by the government of India. So we are not including national saving certificate to M2, right? In fact, in any M0, M1, M2, M3, we will not include national saving certificates, deposit on the behalf of national saving certificates. But M0 is currency with public plus deposit with RBI plus other deposits. In M1, what we add is demand deposit. Demand deposit, be it saving account or current account. In M2, what we add is post office saving deposits maturing in less than 1 year. Maturing in less than 1 year. Now we can learn about M3. So M3 is what? M1 plus time deposit. Now what do you mean by time deposit? Time deposits are nothing but fixed deposits, right? It will mature on a particular time. So it is time deposit. What is saving deposit? What is demand deposit? You can demand your money at any time you want. In time deposit, you can demand your money after a particular period of time. That is fixed deposit. So it is a part of M3. Now comes to M4. M4 is nothing but M3 plus post office deposit maturing in more than 1 year. In less than 1 year, it is part of M2. In more than 1 year, it is part of M4, right? National Savings Certificate is not included. National Savings Certificate is not included. So in question, they are asking you, M4 consists of M3, true, M3. All deposits with the post office saving banks, yes. And National Savings Certificate, no, right? So not National Saving Certificate. So correct option is 1 and 2. Answer is A. So this is it, right? The broad money. So M0 is narrow money. M3 is broad money. M0 is narrow money. M3 is called as broad money. And when you will move from M0 to M3, liquidity will decrease. Liquidity decreases when we move from M0 to M3. See, in M0, what is M0? Currency with the public, right? Currency available with the public or currency in public domain. So liquidity is high. I have 100 rupees cash with me. That is, liquidity is highest. I have money. I can do anything I want with that 100 rupees. But if it is demand deposit, then liquidity is has slightly decreased. I don't have 100 rupees cash with me. I have to go to ATM or my bank branch and I can withdraw 100 rupees. That is there in my saving account, right? So it is demand deposit. What is time deposit? I don't have money right now. I have fixed deposit which will mature after 5 years. So I will be having money after 5 years. So this is what liquidity has declined, right? So this is all about liquidity declining. M0, M1, M2, M3, M4, right? M0 is narrow money, M3 is broad money. So answer is A. I hope you got the answer. Now come to question number 4. Which of the following constitutes narrow money in India? So just now we have done. The narrow money is M0. So currency held by the public, true. Net demand deposit, no. Saving deposit with post office, no. So answer will be 1 only. So question number 4, answer will be A. 1 only. Sorry, net demand deposit held by commercial banks. Net demand deposit. Okay, demand deposit with RBI. And okay. So this is 1 and 2. Demand deposit also there by commercial banks. So answer will be D, 1 and 2. Now come to the next. Explanation is already done in the previous question, so we are not elaborating it much. Now come to question number 5. Consider the following statements regarding wholesale price index. Right? Wholesale price index, WPI. The wholesale price index reflects the changes in the average prices of goods at the wholesale level. So with the name, you can also understand that wholesale price index means at wholesale level. And services are not included in wholesale price index because wholesale, this entire chain is related to, entire distribution chain is related to goods, commodities, not with respect to services. So wholesale price index talks only about goods, commodities, not about services. It does not consider the price of services. True, it does not consider and does not reflect the consumer price situation in the country. So also it is wholesale. So it does not reflect the consumer price, because consumer price is what? Retail price, right? What is consumer price? Retail price. So it is wholesale. So wholesale does not reflect consumer price. True, because as a consumer, when we go to the market and we buy a commodity in less number of pieces, for example 2 pence, 3 pence, so this is consumer price. But when we go to a wholesale market and we purchase the commodities as a wholesaler or as a retailer, we purchase in wholesale market, so the rate is different, right? So WPI does not reflect consumer price, rather it reflects wholesale price. Also, this WPI is not considering the prices of services. It only covers the prices of goods or commodities. It is released by economic advisor in the Ministry of Commerce and Industry. This is also true. So this statement is correct. This is correct. Its base year is 2004-05. It is not correct, because in 2017 this base year was revised as 2011-12. 2011-12. So the current base year is 11-12. 2011-12. So this is current base year. So this statement is incorrect. So the correct option will be B. 1, 2, and 3. 4 is not correct. So WPI is wholesale price index. What you have to remember from this question is WPI is a wholesale price index. It does not include the prices of services, right? It includes only prices of commodities, that is goods. And it is released by economic advisor in the Ministry of Commerce and Industry, because now we will see different indices released by different authorities, right? And it does not reflect the consumer price situation in the country, as it is wholesale, as it is a wholesale price index, right? Okay, so answer will be 1, 2, and 3. In the place of economic advisor in the Ministry of Commerce and Industry, if they say this is Department of Trade and DPIIT, Department of Industry and Internal Trade, DPIIT, then also it is correct, right? If it is replaced by economic advisor in the Ministry of Commerce and Industry, if they say Department of Internal Trade and Industry, it is also Industry and Internal Trade, it is also correct, Department of DPIIT.